Hello guys and welcome again to my channel. So we are still in the manufacturing accounting and the cost accounting in the college. So we have had our illustrative problem so that I could let you see the 10 steps of accounting cycle in manufacturing entities. And in the previous videos, we have talked about making journal entries for that particular illustrative problem as well as putting it in T accounts. Here are the T accounts actually. And then making a 6-column worksheet. 6-column worksheet because we have started with the adjusted trial balance already. Adjusted trial balance because these things are adjusted balances. That means the regular entries are already mixed up or it has been posted already with the adjusting journal entries. Here, so these are the adjusting entries. So again, because of that, we have the adjusted trial balance. And then we have had our income statement, which has only three amounts here, and the statement of financial position. Okay? So we're through with step 5, the completion of worksheet. Okay? Now, step 6, we started the step 6 in the last episode also, which is the main financial statement that I wanted you to see. This is the income statement. So as you can see, you have 520,000 as the sales. The cost of sales is 438, gross profit 82, and the OPEX, it's just the rent expense because in the illustrative problem, I made it as simple as possible, focusing only the unique trades of manufacturing accounting versus the merchandising. Now, so we have rent expense, we have a net income of 72,000. However, we still have had our cost of sales computation because sometimes your users of the financial statements will tend to ask, how did you get this 438,000? So we did these things. So we have our cost of sales before adjustment for the under applied and over applied factory overhead, which is 360. In this case, we have under applied factory overhead, so we added 78. So we have 438,000. Okay? So we're through with the income statement. That's the recap. Let's go to the other financial statements. Okay? So I guess I shouldn't uh, erase this the account because it's needed in other steps. So let me erase this. So what's the next one that we have to process? I guess the statement of changes in equity. So on the statement of changes in equity, we just need to know the net income because we needed that. So, statement of changes in equity. Let me see if it's still recording. Sometimes I talk and talk, and later on, I realize that it's not really recording. So, it's a waste of time. So, let's have the beginning capital. Basically, since I don't know, I have forgotten the beginning capital for this one. Do we have, yeah, we have a beginning capital for this one. So the beginning capital is, if I still remember that right, although I looked at the T account, that's 450 for confirmation. And then you have to add, if ever, there are additional investments in which, in this problem, we have an investment, an additional of 300,000. And aside from that, we have to add the profit. The profit that we have been talking about is 72,000. That is coinciding with the income statement that we have erased a while ago. So that's 72,000. So we can get the total. Did we get the total? You have 450,000 plus 300,000 plus 72,000. You'll have 822,000. And then we have to list the withdrawal drawings if there are any. Do we have drawings? I don't think so. I haven't remembered having drawings in this problem. So there's none. And then we have the loss, if there is a loss. In this case, there is no loss. It's because it resulted to a profit. It's either a profit or a loss. So that is zero. So there is no drawings. So the ending capital is actually 822,000 also. That's it for the statement of changes in equity. It's as easy as that. But then again, you have to make the income statement first because you will need the amounts for the profit and the loss. Okay? Now, let's go to statement of financial position. So, the statement of financial position, you can have the assets first. The assets first. So, we have the assets, and you'll start with the current assets. And on the current assets, of course, the first one is the cash. The cash is 504,000. And then we have the accounts receivable. Then the accounts receivable is 156,000. And then we have the inventories, of course, the raw materials. I don't know if, yeah, it's 156. Raw materials is 160. You have work in process, 50,000. And then the finished goods, 62. And then we have the prepaid rent. So there are a lot of current assets in this particular problem. I mean, that's it for the current assets. 504,000 plus 156,000 plus 160,000 plus 50,000 plus 62,000 plus 20,000. You have 952,000. Okay? Now let's go to the non-current assets. The non-current assets is non-existent. We don't have any in this problem because I'm keeping this illustrative problem very short and focusing only on the unique parts of the manufacturing entities, accounting. Okay? So that's zero. So the total assets is 952,000. Okay. Now, next is we have accounts payable. That is for the liabilities and equity. So on the liability side, we have accounts payable. Let's shortcut it, okay? So we have the accounts payable. So that is the only liability that we have, 130,000. And then the equity, BBG capital, based on the statement of changes in equity, which is 822. Again, I have already shortcutted it because there is only one liability and then there's no non-current liabilities and etc. So this is immediately the total liabilities, 130,000 plus 822,000. You're gonna get 952,000. So that means this is already balanced. So that's the statement of financial position. Okay? Now let's go immediately to statement of cash flows. So I don't know how to okay, statement of cash flows. So on the statement of cash flows, let's put it here so that you'll see everything. So statement of cash flows. The statement of cash flows, you'll start with the operating activities. Cash inflows. So based on the account that I have already prepared for the statement of cash flows, we have the inflows here and there are only three. No, there are only two. There are only three. The cash beginning, the investment by the owners and received from customers. So actually, there's only one line item. Received from customers. How much is the received from customers? It's 364. And then we have payments, right? So we have cash outflows. The cash outflows are payment for raw materials. Let's put that at RM. 150. Let's present it so that we are going to summarize it immediately. And we have the payment for the direct labor, right? And that is 150 still, right? And we have the indirect labor, which is 130. And we have the rent of 30,000. Okay. So all in all, we will see that the result, 364,000 minus 150,000 minus 130,000. How many of 150 did I deduct? There's only one, minus another 150,000 because supposedly there are two deductions for 150,000. And then minus 30,000 finally. And we will have, oh no, negative 96. Negative 96. You see, the cash flow from operating activities is not that really good because you only received 364 from the customers, but your cash outflows are greater. 150 plus 150 plus 130 plus another 30, 460 your cash outflow. So I guess it's very important that you just you do not just check the income statement, because in the income statement, if you remembered, we have positive 72, and we are going to be happy about it because statement of comprehensive income measures the performance of the business. So it meant that the revenues are greater than the expenses, 520 versus 448. However, remember that the income statement is actually accrual basis, in which any revenues that you have earned, even if you have not yet collected those revenues, will be included in the income statement. Okay? So in the cash flow, operating activities is not the case because this is also based on cash basis. Okay? So you only received 364, you have paid these things, so you have negative 96. So I guess you should not be confident about the performance of your company based on our illustrative problem, because we have positive 72 in the income statement, we have negative 96 in cash flow from operating activities. That's a bit not nice. But if you understand the difference is again that is accrual and this is not. And the revenues here, if you see, if you observe, is 520 because that already includes any revenues even if they are not yet collected, so long as you earn them. Here, we only received 364. So if this will happen, normally the businesses will tend to execute efforts in order to collect, so that this will be positive, the income statement, and the cash flow from operations will also be positive. And I guess for me, um, in the question, is the company doing well as to performance? I would like to have a positive net income and a positive net cash flow from operations. That's much better. Okay? And of course, if it is being compared with the past years, I would like to have a bigger net income than the last year or last year's, and cash flow from operations from the last years. Okay? So that's operating activities, and I guess it's negative 96,000. Now, let's move forward. So we have already considered this and this. So basically, we have investment by the owner. So on the investing activities, there are none. So let's put zero to economize the space. And we have the financing. The financing, let's economize the space also. You have additional investment from the owners at 300,000. So that's positive. And then cash beginning of how much is our cash beginning? That's 300. So when you summarize all these things, you will have a cash balance of negative 96,000 plus 300 for the additional investment plus 300,000 on the cash beginning. So you have 504,000. So let's check if we really have 504 in the cash. We have 504,000, 504,000, and 504,000. And the explanation on what comprises the 504,000, basically it's because we have a cash beginning of 300,000, and the owner has invested another 300,000, and supposedly it's 600. However, since we have negative 96 in the operations because of paying for raw materials, direct labor, indirect labor, and rent, and it is far bigger than the receipt from customers. It's like that. Okay? So I hope you understood the financial statements as well as the implication of this one and this one. Okay? So those are all the financial statements. And I guess we are already through with step 6, the preparation of financial statements. Now let's go to step 7. Let me check on. Yeah, we can still go on. On the step 7, of course, you will have the adjusting journal entries and you have to post it here. And since again, in the very beginning, all our journal entries already pertains to regular journal entries and adjusting journal entries. So, as if step 7 has already been done because we have already posted the adjusting journal entries here. Okay? Which is why again, we have the adjusted trial balance immediately. So we can now skip step 7 because it's already done at the very beginning. Okay? Now what's step 8? Step 8 is of course the closing entries are journalized and posted. So the closing entries are meant to close the income and expense accounts as well as the withdrawal. So the income and expense accounts are to be closed to the capital. Okay? So which is why income and expense are actually considered as temporary accounts. Okay? So, yeah, let's do that. Uh, Okay, now let's go to step 8. Closing entries. Journalized and posted. So the first one is close income amounts. So do we have any income right here? Of course, we have sales and there's nothing else. It's only sales. So let's close the sales. So the normal balance of sales is credit. We have to debit it. How much? That's 520. And we have to close it in a temporary account called income summary. Temporary because later on it will also be closed. Income summary is 520. And then number 2, close the expenses. So what are the expenses that we have here? We only have cost of sales. So we can close the cost of sales by crediting it. Cost of sales. Cost of sales is 438,000. And then we will have an income summary also. And we have our rent expense. We have to close that also, which is 10,000. So the income summary is 448. But then again, if ever in the problem, it's not immediately cost of sales. There are actually raw materials beginning, raw materials purchases. Those are the accounts that were used. So you have to enumerate all of those. Like for example, raw materials beginning. That is under the expenses, the raw materials beginning. You will see that those accounts in the enumerated, the raw materials beginning plus raw material purchases, the computation of cost of sales. So that's very long, right? There are a lot of accounts in there. So if ever you see those accounts contributing to cost of sales, meaning if they increase, the cost of sales also increase. That is here in the expenses and you have to close it by crediting it. Okay? Example, raw materials beginning. When it increase, the cost of sales increase. You put it right here. Okay? Again, this is in case the cost of sales is not given directly. There are a lot of accounts, the raw materials beginning, purchases, work in process, direct labor, all of those in the computation of cost of sales. I know you can remember that. If, again, the cost of sales is not given directly, you classify those accounts as to friends of the cost of sales and the enemies of the cost of sales. Friends of the cost of sales, if they increase, the cost of sales increase. Example, raw materials beginning, raw material purchases, right? So those are the friends of cost of sales. You have to put them right here. You have to credit them. Okay? How about raw materials end? Raw materials end is here. Raw materials end, if you remembered, is a deduction to the cost of sales. So if it becomes bigger, the cost of sales will become lower. So you have to close them. The raw materials ending, you have to put it in debit and then income summary. Okay? So it's as easy as that. So next would be the direct labor and the applied factory overhead. Of course, those are to be included here in the expenses. You have to credit them. Because if there is a big direct labor and factory overhead, the cost of sales will also increase. So you have to close it right here, something like that. Which is why I don't like this income and expenses. Close the credits and close the debits so that it will be all inclusive. Like for example, sales. there are times that there are sales returns and sales discounts. Okay? So sales returns and sales discounts has a debit balance, so it should be in this group. So they will be closed by crediting those because they have debit balance and then income summary, something like that. Okay? So I hope I'm clear on that. So continuing, the work in process beginning is in this group because it increases the cost of sales when it increase. The work in process end is here. The finished goods beginning is here. The finished goods end is here. Okay? It depends on the normal balance and it depends if it is a friend of the cost of sales and an enemy or an enemy of cost of sales. Okay? In this case, to have our video shorter, let's have cost of sales. Although we know that this cost of sales is complicated in its computation or composition. Okay? So that's it. Number 3, you close the income summary. So in this case, 520 minus 448, it's 72. This one. So I'll shortcut. I will not make calculations using calculator already. So it's 72. And since the credits are greater, that means the normal balance of the income summary at this point, if you summarize this, is income summary 72,000 credit. So in order to close the income summary, you have to debit it. Income summary 72,000 and then credit, what's our capital? Baby G capital. Yeah, that's it. And the fourth one is the withdrawals. And since we don't have any drawings in here, yeah, we don't have any transaction about the drawings, so there will be no entry. So the first half of step 8 is already finished. The closing entries have been successfully journalized. Now, let's go to the half and post everything. So if we post the sales here, we'll have 520. The sales will be reduced to 0. Instead the 520 here, this is the final 0 because of posting the closing entry. And then we have to make a very temporary account which is known as income summary. On the income summary, you have to put 520. So this is already posted. Next, we have the cost of sales and rent expense. You have to credit them. So the cost of sales is 438, which makes the cost of sales 0 instead of this 438 here. And then we have the rent expense. Where's the rent expense? Here, the rent expense. So this will be out. This will become 0. This is out, 0. This is out, 0. So we have the income summary, of course, of 448. Where is the income summary? 448. Okay? Now, next, this has been posted already. Number 3, let's post. Income summary 72, debit. So, because of that, this will become 0 also, the income summary. The most temporary account, the income summary. And then, BBG capital. So, instead of 750 only, we are to add 72,000. Yeah, 72. Right. So, we have 72. And I hope this 750 plus 72, it's basically the same with 750 plus 72, 822. I hope that earlier it coincided with our statement of changes in equity because that is the only checking that we can do if ever you are correct in closing entries. Eh, basically, you are correct in everything. The closing entries are journalized and posted. So supposedly, the BBG capital account is the same with the capital ending account on your statement of changes in equity. And as far as remembered, it coincided. Okay? So that's it for step 8. So the result for step 8, the closing entries are first the income accounts have been closed, and then the expenses or the debits have already been closed to income summary. And then the income summary later on has been closed also. So the drawings is to be closed also. So the ending is always the capital. The capital is changed because the income, the expense, the withdrawals have been closed to capital actually. Okay? Now, what's step 9? Step 9 is making a post-closing trial balance in which you have to list all the account balances again in the ledger. However, this time, the sales, the cost of sales, and the rent expense are already zero. So, on the step 9, it's the preparation of post-closing trial balance. So, the post-closing trial balance is, you'll start with cash. So, it's 504,000 debit, 504,000. You have your accounts receivable. This was not changed. It's still 156,000. And then the raw materials is still 160. And the work in process, I'll follow this instead of looking for the amounts there, because again, these amounts that I am looking at now are balance sheet accounts. They are not temporary accounts. They are permanent accounts. And the only ones that were affected are the income statement accounts, the income and the expense and the drawings. So it's safe that you are going to look at the numbers here for the balance sheet accounts or the statement of financial position accounts. So we have finished goods. Anyways, these amounts coincide also with here. So finished goods is 62. And the prepaid rent, still, this is not an income statement account. So it has been preserved. The balance has been preserved, if I'm not mistaken. Where is the prepaid rent? This is the rent expense. Here's the prepaid rent. And then the accounts payable. The accounts payable is 130,000. And then, lastly, the BBG capital. We cannot copy already from here. We have to have the updated, the 822,000. And that's it. 504,000 plus 156,000 plus 160,000 plus 50,000 plus 62,000 plus 20,000. It's 952. And then we have 130,000 plus 822,000. It's 952,000. Step 10. We just have to reverse entries. And normally, again, the reversing entries will happen in the first day of the next period. Like for example, if our last period is December 31, 20x5. On January 1, 20x6, you have to have the reversing entries, but not have to have. Reversing entries is actually optional. Okay? So, you can choose not to reverse the entries if you wanted to. And if you wanted to have the logic we need, why some accountants needed to reverse entries, you can go to the previous videos. Okay? Well, at this point, I would just have to enumerate what are those entries that have to be reversed. Example, number one, we have the accrued expenses. The accrued expenses are the expenses that you incurred but you did not pay. And normally, the adjusting entry for the accrued expenses is debit expenses, credit payable. Now, when you reverse it, you debit the payable and you credit the expenses. That's it. Okay? Next, that item number two is the accrued revenues. The accrued revenues are revenues that you have already earned because you have already given the services and the goods to the clients or the customers, but they did not yet pay. So normally, the adjusting entry for that is debit receivable and then credit revenues. So when you reverse it, of course, you have to debit the revenue and then you have to credit the receivable. Okay, that's item two. The third one is the adjusting entry for deferred expenses, which are accounted for using expense method. So deferred expenses are your advance payments to somebody without consuming first the benefits. You advance paid. Okay? You did not incur that expense yet, you paid in advance. So what will happen? You can either choose to record it as first an asset. So like for example, prepaid rent and then credit cash. Okay? Any adjusting entry using asset method, it's not reversed anymore. Only those adjusting entries of deferred expenses using expense method. Okay? You have to remember that. And if you wanted some clarification, you go to the previous episodes, guys. So again, the third item are the deferred expenses. The adjustment for the deferred expenses accounted for using expense method. Okay? And the last one is the deferred revenues adjustment. The adjusting entry for the deferred revenues. Not the initial entry, the adjusting entry. Okay? Accounted for using revenue method. So deferred revenues are advance payments from customers. Okay? So advance payments from customers, you could put it as a liability because you have not yet earned it. You have not given services and goods yet. But you can also choose to account it as revenues. Okay? So if you account it as revenues, there will be an adjusting entry. So that adjusting entry is the ones that should be reversed. Okay? So those are the only four items that you have to reverse. And in this particular problem, again, we don't have any reversing entry because, again, our adjusting entries are actually, we don't have any accrued expenses. If you can remember, accrued expenses are expenses incurred but not yet paid. We don't have any in this problem. We don't have any accrued revenues, right? In the adjustment. We don't have. And then we have deferred expenses, the prepaid rent, but that prepaid rent has been accounted for using asset method. So we don't have any to reverse. Okay? Because we only consider reversing the adjusting entry of the deferred expenses accounted for using expense method. Okay? And of course, we don't have any deferred revenues. As you can see, we don't have any unearned service revenues. So, this is the final video for accounting cycles. I will not discuss anymore about accounting cycle. We have done this a lot of times already. We have had our accounting cycle for service entities. We have had our accounting cycle for merchandise entities. And we have had our accounting cycle for the manufacturing. And I have shown you already that manufacturing entities accounting has an accounting cycle also. Okay? So on the next videos in this series, um, we will tackle topic by topic already. The logic of the topic, it's still a storytelling, but I guess when you started from the very beginning of this series until now, congratulations because you have graduated in the topic accounting cycle step 1 to 10. The identification of transactions, the journalizing, the posting to the ledger, the making of the unadjusted trial balance, the completion of the worksheet, the preparation of the financial statements, the adjusting entries are journalized and posted for step 7, making of closing entries and posting it to the ledger, that's step 8. Step 9 is post closing trial balance. Step 10 are reversing entries. So in the next episode, we're still going to have the cost accounting series, but this time we will answer a particular question. Actually, the cost accounting resembles a simple concept. Like the accounting for me itself is just what are the costs to be accounted for and where did it go so as accounted. So it's as if there is a cash, for example, entrusted to someone, like he's been entrusted with 50,000, 60,000, a lot of times he has been given cash, totaling already to 2 million. Where did it go? So that's as accounted for. So, for example, the 1 million, the total is 1 million. Where did it go? So, if that person you entrusted the cash with is also given the power to disburse those things in legitimate reasons, for legitimate reasons or purposes, or for business purposes, as accounted for, you will find that 1 million. It's either on source documents like official receipts, sales invoices, and etc. Okay, or the remainder cash. Okay, so I guess that's for me is accounting, the to be accounted for and as accounted. Okay, so in cost accounting it's like that, but the story here is just on the costs, direct materials, direct labor, and factory overhead. Those are the main costs, product cost. Where did it go, those costs? Did it go to the finished goods? Did it go to the work in process ending? Or did it go to cost of sales? Something like that. So that will be our topic on the next episodes. Like these things, the costs of direct materials, direct labor, and factory overhead are actually going to the finished goods, work in process, and the cost of sales. The question is how much. So there are a lot of techniques. Like for example, we have job order system, accumulation of cost, whereby these costs, direct materials, direct labor, and factory overhead, are subdivided into different jobs that you are working. Okay? And we have also process costing, whereby these costs are being subdivided into the finished goods and work in process of each of the departments, something like that. Again, our topic will be looking out, looking for where did the direct materials cost, direct labor, and factory overhead go. Is it in the work in process? Is it in the finished goods? Or has it been expensed outright? Something like that on the next videos. So be excited and see you on my next one. Bye-bye.